Welcome back. You're still watching FinWeek Money Matters. Warren Buffett. Now, he not only got rich through value investing, he also made the investment style famous. Buying undervalued companies at a reduced price is an investment strategy many still subscribe to. But since 2008, South African value investors have struggled to beat the market. Many believe a constant access to information and a changing market places the sound, or rather, could spell the kiss of death for value investing, and that growth investing will reign supreme. In studio with me to discuss what the outlook for value investors is Andrew Nell. He's the head of business development at Cannon Asset Managers. And in Cape Town, we have Sam Hooley. He's the head of unconstrained strategies at Momentum Asset Management. And Yana Murray is still with us. Let me start with you, Sam. Last week, we did a whole feature looking at value investing and whether this is the end for it. So maybe let's find out what your stance is with regards to value investing and what is it exactly?
Yes, thank you very much. It's good to be here. I think the most important thing is, simplistically, value investing is really trying to buy something in the stock market below what it's worth. So in value investing speak, if you think of what something's worth, the price is below that, and you have a margin of safety or a cushion between what the stock is trading at and the value. So that is what value investing is. And really, value investors typically try to do that by buying stocks that trade at low price to earnings, low price to cash flow, low price to asset value, because that's indicative of that margin of safety that I spoke about. So simply, that's what value investing is.
Andrew, let me come to you. What's your stance on value investing, and is this the end? You know, they spoke about past 2008. There have been so many changes that are happening, and there are possibly other strategies that we should be considering.
Well, to build on Sam's point, which I agree with, I think another important distinction between value and its most common counterpart, growth investing, is that for the most part, value investing tends to be a backward-looking endeavor. In other words, how much is this company worth relative to its historical value, using different measures, whereas growth investors are looking to the future. Because I think it's safe to say that any investor is looking to buy something today which will be worth more tomorrow. That doesn't make you a value investor. I think that makes you have common sense. A growth investor is saying, what is tomorrow's prospect that makes us relatively cheap? And so it's a forecast of sorts. Our stance on whether value is dead and buried, or the kiss of death, I think was a phrase you used, is one we certainly don't subscribe to. It is fair to say that the current cycle in which value has struggled and growth and momentum has done very well is longer than we've seen in modern history in South Africa, and indeed around many parts of the world. That doesn't make us question that value investing is over. Styles come in cycles, and by definition that means sometimes they're hot and sometimes they're not. Our stance, and I suspect that Sam's is similar, is that while there are cycles, if you stick to one strategy over another, over time value does triumph.
Yana, let's bring you into the conversation here. I don't know if Sam has had any words that he'd like to bring in, or something that you'd like to ask about this conversation.
To be sure, I must say I heard you very badly, but if I can jump in there with a question, I think for me the interesting thing, is the amount of work that goes into value investing, and the amount of ratios. It just sounds like a lot of work, and then you sit in an environment where value investors will tell you now is a great time, for example, to buy commodities because they're cheap, and but I suppose my question is, how much patience do you need, and when will we see this? Do Sam and Andrew, do you guys believe the cycle will turn for you, and why are you sticking to your guns?
Maybe let me start with you, Andrew.
Are you happy for me to go ahead?
Okay, well, let's start with you then, Sam.
Sorry.
Yes, I think that in answering the question that Yana has just posed, it is clear that this has been a very long cycle, and there is a lot of work that goes into determining whether something is truly undervalued. But at the same time, I think that if you have the discipline of doing that with every single stock, ultimately you build up a portfolio that's made up of stocks that are in fact actually undervalued and meet your criteria. So really the discipline that comes with value investing is very important, and also the temperament to really go against the grain, mainly because when stocks are cheap and trading at cheap multiples, they typically go hand in hand with being unpopular, out of favor, and they have a lot of controversy and bad news associated with it. And of course, these cycles are long. Andrew made many good points, all of which I agree with. The key thing is that 2008 might have been the point at which, if you look back now, that value investing hasn't quite worked. The truth is that value investing, in fact, worked very well from the bottom of the cycle in 2008 and early 2009 to probably around 2011, where most strategies worked well because the entire market was very cheap. It's only really in 2012 and in recent years that value investing as a style has struggled, which is precisely what we expect, because you're not really buying the winners simply because their winners are popular, which is what price momentum investing is, and you're definitely not wanting to overpay for growth, because the truth is that value investors are willing to pay for growth, because that's how you grow. We're just not willing to pay up for that growth. So I would rather contrast value investing with pure price momentum investing, which I think really is a case of buying the winners because they're popular, simply because they have been winning, as opposed to buying things that are truly cheap. So these things work in cycles. It requires discipline, and the cycle turns. Mean reversion really takes you back. So we have great faith in that, and we're sticking to it.
Sam, let me now come to Andrew. I know you've heard what Sam has had to say, with what he said in the question that Jana had. What do we do with all the macroeconomic developments, ECB pumping in 1.1 trillion euros? What is this going to spell for value investors as well?
You know, the exact cause of what has caused value to lag other investment strategies is widely held to be linked to quantitative easing in one shape or form. But you know, the ongoing low interest rate environment, lots of liquidity, does pose some potential headwinds to the investment style. However, that doesn't change the fact that the philosophy is still looking for a good business at a good price. Now, perhaps I can give you an example that might illustrate it well. If you look back to 2014 in South Africa, one of our big headlines was African Bank. African Bank in itself had problems, but it was also in the context or the environment of a struggling economy, until recently, rising inflation, stubbornly high unemployment, and all of those things pointed to very tricky times, not just for the lenders, but people in that industry, retailers as an example, or credit retailers, and Lewis is the company that springs to mind. Now, this is a company that we've held at Cannon for some time. It's a good business. I don't think it would be fair to call it glamorous. It's just a well-run, well-established business where management knows what it is they're about. They don't try and do anything too clever. They pay a good yield. They look after their balance sheet. And later in 2014, it really found some support from the investment community. Perhaps that ties in with a falling oil price and some consumer relief, but it really has rocketed well, not because the industry is suddenly easy or they've suddenly had a stroke of brilliance as management, but the company is mean reverting, and that's the word that Sam used a bit later on. We are reliant on mean reversion. Is this company going to go back to where it was on a valuation basis? And if you have conviction in the stability of the business and its ability to carry on running as a going concern, there's support for the argument.
Sam, just closing comments from you. We do have to wrap up our conversation, unfortunately, but going forward, I think you've made your stance pretty clear when it comes to value investing, but would you say a hybrid model, that's probably the way investors should go?
Yes, I think that the fact that value has had a difficult cycle for a long period, that is in fact a very good signal, because typically and traditionally has been a case where just as it looks as though it hasn't worked really well, it's precisely the time where you must make a big allocation. And I think that these styles work in over time and in cycles. So we're very optimistic that over time this will work. and that it's probably closer than most people are willing to think, because it's not something you can time.
Thank you so much, gentlemen, for making the time to join us, and of course, Jana Marais as well. That's all for this week's edition of FinWeek Money Matters. Thanks once again to our guest. That's Andrew Newell. Am I saying it right this time?
Right.
Okay, he's the Head of Business Development at Cannon Asset Managers, and Sam Hooley, Head of Unconstrained Strategies at Momentum Asset Management, and of course, that Jana Marais, she's the editor of FinWeek.